I am your host, Kristi Humphrey. I will be your host for all three webinars. I am a senior manager at Shampoo, Travis, Basta, and Kirshner. And my guest host today for this webinar is Kevin Basta. You want to do a quick introduction, Kevin?
Yeah, thanks, Kristi. I'm a manager here at CTBK, and I'm happy to be here today and covering the basics of topic 842 with everyone.
Thank you. So we'll go ahead and get started.
So taking a look at today's agenda, what we'll be covering, we'll start off with an overview of topic 842, just a high level, what is it? Moving on, we'll look at the scope of topic 842. We'll then look at we'll walk through a detailed example of lessee accounting for operating leases, and that will include actual journal entries. And then using that example, we'll then move into footnote disclosures. So what to know about leases? First, I'd like to thank everyone for attending today, and I hope that you join us for parts 2 and 3. You have obviously taken a step in the right direction on educating yourself on the new standard. So just as a general overview, what is ASU 2016-02? So this new standard requires a lessee to include all leases on the balance sheet. It requires a lessee to classify a lease as finance or as operating to determine the applicable accounting treatment. So as a refresher, finance lease, formerly known as a capital lease under topic 840. So if at its inception, a lease meets one or more of the following criteria, the lease must be classified as a finance lease. The first, the lease transfers ownership of the property to the lessee by the end of the lease term. Second, the lease contains a bargain purchase option, such as $1. The third, the lease term is equal to 75% or more of the estimated economic life of the lease property. And the fourth, the present value at the beginning of the lease term of the minimum lease payments, excluding certain costs, equals or exceeds 90% of the excess of the fair market value of the lease property at the inception of the lease. So under this new guidance, finance leases is substantially the same as they were under topic 840. And as in regards to operating leases, as previously mentioned, the new standard will now require recognition of a right of use asset and lease liability on the balance sheet. Next slide, please. So this chart summarizes how topic 842 has changed the accounting treatment for leases. And as I just mentioned, as you could see, the accounting treatment for finance leases is substantially the same as it was as a capital lease under topic 840 for recognition on the balance sheet, income statement, and statement of cash flows. And then in regards to operating leases, as previously mentioned, topic 842 now requires a lessee to recognize the right of use asset and related lease liability on the balance sheet. However, there is no change in treatment from topic 840 for operating leases on the income statement or statement of cash flows. So how to adopt the new standard? So topic 842 is effective for calendar year 2022 for companies with a December 31st year end. For companies with a fiscal year end, such as June 30th for a not-for-profit entity, topic 842 is effective for interim periods beginning after December 15th, 2022. So for example, a not-for-profit with a June 30th year end, the new standard will go into effect for the fiscal year end, June 30th, 2023. Topic 842 can be adopted using two options. The first is the beginning of the earliest comparative period presented with comparative periods adjusted, or under option 2, which is more simple and our recommended option for adopting topic 842 is the effective date method, with comparative periods not adjusted or on a prospective basis. There are certain practical expedients permitted for adopting Topic 842. We believe some of the most common to be electing not to separate lease and non-lease components, not applying Topic 842 to leases with a lease term of 12 months or less, and not reassessing lease classification of current leases at adoption. So now transitioning more into the scope of Topic 842. So as I previously just mentioned, I talked about lease and non-lease components. So Topic 842 requires a lessee to identify lease and non-lease components and allocate payments to each. So for example, if a lessee leases office space that has communal parking or common areas, this typically does not allow a lessee the right to control these areas and would be categorized as a non-lease component. The lessor must then account for these non-lease components under ASU 2014-09, Topic 606. However, as I previously mentioned, a lessee can use a practical expedient to group the non-lease components with the lease components to simplify adopting Topic 842. In regards to embedded leases, as a refresher, an embedded lease are components within contracts that entail the use of a particular asset where the user has control over the asset. An example would be a postage meter or IT agreements that may contain use of cloud servers or data management systems. In lease webinars parts 2 and 3, we will take a deeper dive into embedded leases. So just taking a step back and asking, what is a lease? Topic 842 defines a lease as a contract or part of a contract that conveys the right to control the use of an identified asset, such as property or equipment, for a period of time in exchange for consideration. The key words in this definition are right to control. You must consider, does the customer have the right to obtain substantially all economic benefits from the use of the identified asset and the right to direct use of the identified asset? So what is an identifiable asset? Identification of an asset is generally analyzed by looking for an asset explicitly identified in a contract. A key factor that you must consider is the concept of substantive substitution rights. Once an asset is identified, you must consider whether the supplier has a substantive right to substitute the asset throughout the period of use. A supplier is said to have substantive substitution when the supplier has the practical ability to substitute alternative assets throughout the period of use, and the supplier would benefit economically from exercising its right to substitute the asset. Therefore, the existence of substantive substitution right calls into question whether there is an identified asset and whether a lease actually does indeed exist. Certain agreements are outside of the scope of Topic 842, and presented here are some examples of such arrangements. For example, leases of intangible assets such as cloud computing arrangements. Guidance for these arrangements can be found in ASC 350, Intangibles, Goodwill, and Other. And another example includes leases of assets that are under construction, and guidance for these arrangements can be found in ASC 360, Property, Plant, and Equipment. And with that, I'm going to turn it back over to Kristi to continue talking about the scope of Topic 842.
Thanks, Kevin. So now that we've kind of gone over a high level of the scope, I am going to walk you through from the lessee's position what the accounting would look like. So the place that I'm going to start is, now that we've identified we have an operating lease, we are going to record a right of use asset and an operating lease liability. So I'm going to start on the right-hand side with you, and let's go through how would we calculate the operating lease liability. So it is calculated as the present value of future minimum lease payments. The discount rate that you would use in that calculation, there are a few options. So if the contract actually has a rate within it, that rate would first be used. However, in many leases, there may be no rate specifically identified in the lease. In that case, the lessee has the option to use their incremental borrowing rate. And if you're a non-public entity, you also have the ability to use a risk-free rate, which is typically like the 3-month treasury bill rate. If you decide to use the risk-free rate, that might actually result in a higher lease liability and right of use asset. So consider that when you're making your election, whether to use the incremental borrowing rate or the risk-free rate. In addition, something good to note is you can actually use the rate that is determined as of the implementation date. So you don't have to go back through all your leases, go back to the period that they started and determine what the discount rate was at that point in time. So if the date you decide to implement it, if it's for calendar year 2022 and you're implementing for January 1st, 2022, you can use the rate as of that implementation date. So that's the operating lease liability. Now, if I move over to the left-hand side, which is the right of use asset, I am going to take, that's going to be calculated as starting with my lease liability that I've just calculated. Other considerations are you're going to add any initial direct costs. So those may be direct costs, not necessarily related to negotiating the contract, but those costs that would not have been incurred if the lease wasn't executed. A great example to give is if the lease is executed and you have to make a payment to the current tenant to remove them from it, that would be an initial direct cost that was incurred because you signed that lease. And that would be added to the calculation of the right of use asset. In addition to initial direct costs, you're also going to add any prepaid lease payments. So if you have a lease payment you need to make upfront in advance of the lease, that would be added to it. And then you would reduce that right of use asset by any lease incentives incurred. So a common area for a lease incentive may be if as part of the lease, the lessee is required to make some leasehold improvements. That may be, classified as a lease incentive, and you'll reduce that right of use asset. So getting into a little bit more detail, how to measure the lease liability. So the lease liability, as I mentioned before, was the present value of the unpaid lease payments. So let's talk about the components of what that would be going into that calculation. The lease payments are typically the fixed payments in the contract. You would not typically include variable or contingent payments, other than variable payments based on an index. So if you have variable payments based on LIBOR or Prime, those would be included in the calculation of lease payments in calculating the lease liability. If you have a contingent payment that's based on your operations, on revenues, those would be excluded from the calculation. So they're typically fixed payments or variable that are specific to an index. The discount rate, as we had mentioned on the previous slide, you're first going to see if there is a rate noted within the lease. Otherwise, you can use your incremental borrowing rate or the risk-free rate. And then finally, the lease term. So what term are you going to use when you're calculating the present value of the unpaid lease payments? So that term is typically going to be the non-cancelable periods, along with options to extend. And let me clarify that. So the options to extend, if it's reasonably certain that those options are going to be exercised by the lessee, you would include that within the lease term when you're calculating the present value. Or if the lessor actually controls the option. The assumption would be if the lessor controls the option that they're most likely going to extend, so you would include that option periods within that lease term. So now I'm going to take a quick break and I'm going to give you your first keyword. So this is one of the keywords that we had mentioned, that once you get the survey at the end, you will enter this keyword into that survey question. So that first keyword that I'm going to give you is sandwich. And why do you ask, do I choose sandwich? Because for those of you that don't know, today is National Sandwich Day. So if you didn't have your breakfast sandwich for breakfast or eat a sandwich for lunch, you still have at least one more meal, or maybe many. I don't know how many meals you eat in the evening to exercise your option to eat your sandwich for National Sandwich Day. So again, our keyword, first keyword, is sandwich. Now that I've kind of walked through what that calculation looks like, I'm going to go through a detailed example from the lessee side of a very simple lessee accounting. Now, in Lease Webinar 2, that's going on next Wednesday, I will get into a little bit more complicated examples for those of you that want to come to that. So this is a very simple lease. In Lease Webinar 2, I will go through what a variable lease payment example looks like, as well as a lease that includes some initial direct costs. And what does the accounting look like from that perspective? So both of those more detailed examples, as well as a revisit of this example, will be provided in Lease Webinar 2. So let's look at that simple example. What does that lease accounting looks like? So in my particular example, the lessee enters into a 10-year annuity. The lease agreement requires annual payments of $162,745. The lessee's incremental borrowing rate is 10%. Apparently, this lease was for many years ago because we know that rates aren't that high anymore. And the present value calculated using these information is $1 million. So in this very simple example, I went and calculated the present value of my lease payments using the payments, the borrowing rate, and the term, which is a 10-year annuity, no options to extend. And I calculated the present value was $1 million. So my lease liability is $1 million. Now, because I didn't have any initial direct costs, prepaid lease payments, lease incentives, my right of use asset is also $1 million. So my journal entry is debit right of use asset and credit my lease liability for $1 million. At this point in time, they both match. So one of the areas I wanted to walk through with you in a little bit of detail is how to calculate that right of use asset amortization. Because one of the key things you will see in lease accounting is that the lease expense needs to be straight lined. So in looking at that, I'm going to show you how you get to that right of use asset amortization. So in the first box, as I mentioned, that lease expense is straight lined. In my very easy example, I am paying $162,745 each year. So my lease expense straight line will be $162,745 each year. Again, in Lease Webinar 2, I'll walk you through a variable payment. So for example, if I have $150,000 as my first year lease payment and my second year is $175,000, in this case, I need that lease expense to actually be straight lined over those 2 years. So that's where that second part will give, you still need to have that lease expense straight lined. In my easy example here, it's just the $162,745. From that, I'm going to subtract my interest from my lease liability. So my lease liability was $1 million. We just recorded it. And as I mentioned, I'm using the 10% incremental borrowing rate. So in year one, I am going to subtract from that $100,000, which is essentially my interest. So my first year right of use asset amortization would be $62,745. When I look at year 2, again, that lease expense is straight line, so the same amount, $162,745. But now if I take that $1 million right of use asset and I subtract my first year right of use asset amortization of $62,745, I am going to have $937,255 for my lease liability. And I'll show that in a little bit more detail on the second page. So $937,255, using that same 10%, I now have interest of $93,726. And my right of use asset amortization is $69,019 for year 2. So to go over what the journal entries would look like in recording at that first end of year, as I mentioned, the lease expense, which would be straight lines, in my simple example is the $162,745 times 10 years divided by 10 years, would just be the $162,745. Again, in lease webinar 2, I'll show you what a variable payment kind of looks like. Those would still have to be a straight line expense. I would credit my lease liability for basically the accrued interest. So my lease liability is $1 million at the beginning of the year times the 10%, the borrowing rate. So I'm going to credit the lease liability for $100,000. And then my right of use asset, I'm going to credit my right of use asset for the difference between the $162,745 and the $100,000, which is the $62,745. In addition, at the end of year 1, I'm actually going to make a lease payment. So I am going to debit my lease liability for $162,745, reducing it by that first payment, and credit my cash as I made the payment. So we did break it down down below in the journal entry, so you can see the 2 separate parts. You can see that we debited the lease expense, credited the lease liability, credited the right of use asset, debited the lease liability, and credited cash. So you can see my lease liability is essentially reduced in this case by an amount that's very similar to my right of use asset. Again, that will happen in this very simple example, and I'll show you that on the next page. When you get into more detailed examples, variable lease payments, you have initial direct costs where your right of use asset may be larger than your lease liability. Those amounts may differ. So here you can see at the end of year 1, after recording those entries, my right of use asset was $1 million at the beginning when I recorded it. My amortization for the first year was $62,745. So at the end of the year, I have $937,255 in my right of use asset. My lease liability started at $1 million. We added interest to it. We deducted that first year payment. And so in this case, they both match. And then end of year 2, as we'd mentioned on the previous slide, my amortization is slightly different on my right of use asset. So I'm taking that 937, reducing it by the amortization, and I get to 868,236. And my lease liability, adding the interest, reducing my payment. And again, because of this very simple example, my right of use asset and my lease liability will match at the end of both years. This slide, I'm not going to go through in details, but as we mentioned, reminding you what a finance lease looks like on the balance sheet, income statement, and cash flows. That's really resembling what a capital lease had looked like previously. There really isn't that much change on that side. On the operating lease side, this is where it's different. So we talked about that balance sheet. You're going to have a right of use asset and a lease liability. Your income statement is still going to have lease expense, as it always has, and your statement of cash flows is still going to reflect those lease payments flowing through the operating side. And now I'm going to turn it over to Kevin to continue with disclosures.
Thanks, Kristi. So we're going to continue with some of the required footnote disclosures under topic 842 using continue with the example that we just walked through. So for those who are logged in here for the CPE, we're going to go to our second keyword, which is basketball. And the reason for that is I'm a big college basketball guy, and with the season starting here in a couple weeks, I'm specifically a big Duke fan, and Coach K's last year at Duke, so he's had a phenomenal run there. So looking forward to the season. But so the second key word again is basketball. So the disclosure objective of topic 842 is to provide financial statement users sufficient information to assess the amount, timing, and uncertainty of cash flows arising from leases. To achieve this objective, a lessee's disclosures will include qualitative disclosures, such as information about the nature of leases, related party leasing arrangements, and short-term lease accounting policy election, in addition to quantitative disclosures, such as operating lease cost, weighted average remaining lease term, weighted average discount rate, and a maturity analysis of lease liabilities. In addition, significant judgments and assumptions made are required to be disclosed in the footnotes under topic 842. Next slide, please. So presented here is an example of language that would be included in footnote 1 of the summary of significant accounting policies in the year of adoption of topic 842. So as you can see, the disclosures include the method used to adopt the new standard, which in our example is the effective date transition method, which again is the more simple and recommended transition approach, which is a prospective approach with prior periods not adjusted. In addition, the disclosures include significant judgments and assumptions made, such as excluding all leases with an initial term of 12 months or less from recognition requirements of topic 842, and grouping leases by asset type, which have similar lease terms and payment schedules. And presented here is an example of disclosures in narrative form, which would be included in a separate lease footnote to the financial statements, which includes the nature of the lease, the commencement and expiration date of the arrangement, in addition to the annual rental payments made under the agreement. Also disclosed are the amounts recognized within the financial statements, such as the ending balance of the right of use asset and lease liability, and the discount rate used. Last, disclosed are the terms of the agreements entered into by the company at the balance sheet date, but for which the agreement has not yet commenced. And this is very important to note that you must have these disclosures separated by type of lease, operating and financing. You must have them for both. You cannot combine them into one. Presented is an example of disclosures in tabular form, broken down by lease type, again, by operating and financing. So as you can see, the annual rent expense, ending balance of the right of use asset, and lease liability is broken out by lease type. You can see that we have also presented a current portion of future maturities of 12 months or less. So either method you choose for your footnote presentation, either narrative or tabular, they're both accepted, and they both disclose the same information and achieve the same disclosure objective under topic 842. And presented is quantitative information required to be disclosed under topic 842, such as the weighted average remaining lease term in years and the weighted average discount rate. Since the example that we just walked through, we assume that there was only one lease in place, you can see that the weighted average remaining lease term and the weighted average discount rate relate only to the one agreement. So again, in our example, we assumed that it was a 10-year annuity. That was the only lease in place. And at the end of year one, there'd be 9 years remaining. So for example, here, our weighted average is 9 years. However, if you did have multiple leasing arrangements in place, you would take the sum of the remaining lease terms and years, divide by the number of lease arrangements to arrive at your weighted average. And also presented is supplemental cash flow information required to be disclosed under topic 842. Again, this must be broken out by lease type, operating, and financing. And last, an undiscounted maturity analysis for the next 5 years is required to be disclosed with a reconciliation of the present value discount to tie back to the ending balance of the lease liability. So again, in our example, we assumed that annual payments were $162,745. So at the end of the first year of adoption, which would be December 31st, 2022, we then have 9 years remaining. So we have our future maturities for the next 5 years and 4 years thereafter, less the present value discount to arrive at the ending balance of the lease liability on the balance sheet.
Now, that is our content for today. We did reserve some time for questions, and Caitlin, who's our monitor. So I don't know if you guys can see, but we're going to do a quick stretch because my lights tend to shut off after 45 minutes. So the only way I can get them to come back on is, to kind of stretch out and do a little bit of motion. So nothing I can do to control that factor. But anyways, that concludes the content that we were delivering today. We'll get to questions in a sec. I do want to remind everybody that we are hosting another lease webinar next Wednesday from 1 to 2 and the following Wednesday from 1 to 2, with next Wednesday's webinar being more about what are the actionable items, considerations that I can do to start implementing the new lease standard, as well as going through more detailed examples in the accounting for what a variable lease looks like. So leases with variable lease payments, as well as a lease that has some initial direct costs. So we'll go through more detailed accounting on those particular examples in next Wednesday's lease webinar. And then that final lease webinar is really those special considerations. So going through related party leases, lease sales back transactions, lease modifications. So what do you do when the lease has been modified? Do you write off that right of use asset? Do you add to that right of use asset? So if you don't have that link for those additional webinars, we will definitely send that out to everybody that's participating today or has registered for today's event. So you can sit in on those as well. Any questions that we don't get to today, or even if you think of a question after the fact, so maybe tomorrow, feel free to reach out to Kevin or I directly. You can see up on our screen is our email addresses. And Kevin and I would be happy to answer any questions that you might have. And so now I will ask Caitlin if we have any Q&A that kind of came in.
Hi, Kristi. Yeah, so we have had a couple people ask about the slide deck. So I just figured I'd let everyone know that we will be sending out the presentation to attendees later on this week via email. And also to keep an eye out, you should be getting a follow-up email tomorrow, about 24 hours after the start of the event with the survey. It should also pop up at the end of this webinar, but if for any reason you don't see that on your screen when we close out this session, just know that you will get it in an email tomorrow. And again, if you don't get it at all or you need it resent, you can always reach out to Kristi or Kevin. But other than that, we did have a couple other questions. I think this might be for Kristi, but Kevin, of course, feel free to jump in. The one question is, where on the balance sheet do I present the operating lease ROU asset?
Okay, so the right of use asset. So that would typically be presented as a separate line on the balance sheet. So for financing leases, those are typically in like the property, plant, and equipment section. For the operating lease, it's typically a separate line. If you choose to group it within property, plant, and equipment, you do definitely have to identify it out separately. So the recommendation from all the standards is to leave it as a simple, its own line on the balance sheet. And that is my recommendation, as a right of use asset from operating leases.
Awesome, thank you. Another question is, are CAM charges with an office lease considered variable component?
It depends. I'm going to take this question, Kevin. So I'm guessing your CAM charges or maintenance charges is, I think, what you're referring to. It depends on if it's variable or if it's a fixed charge. So that is the first thing to look at. But I am also going to refer you to the second lease webinar where we get into a little bit more detail on what constitutes those lease payments and some of those particulars with CAM charges or maintenance charges and common area charges in there.
Thanks. Another question is, what sparked these new rules to come about and be pushed through in 2022? Was it legislation made by government entities, and why?
I can field that question. So this was issued by the FASB. It originally was supposed to go into effect. It was delayed several times due to the COVID-19 pandemic. But really the objective of what the FASB was trying to achieve is for financial statement users to provide them with sufficient information to assess the amount, the timing, and certainty of cash flows arising from leases. So there was not necessarily any governmental regulations for the change. You just never know, why sometimes the FASB, comes out with these proposed changes.
Thanks, Kevin. Another question we got is, if there's an expired lease and therefore the company's operating on a month-to-month basis while a new lease is being negotiated, do they have to account for this lease that's under the new guidance?
Yes, that's a great question, because oftentimes we do see that where there could be a contract in place and it's expired, and both the lessee and the lessor are both under the assumption that it's in place and still making the required payments. But the answer to that question would be no. Since the lease agreement has expired, there is no binding contract in place. Even though you do have the right to control the asset in exchange for consideration, there's no legal obligation. So in that case, topic 842 would not be applicable.
And I will add to that, Kevin, again, our lease webinar 3 talks about lease modifications. So if instead of expiring, the lease is actually modified before the lease term is quite over, we will actually cover that topic in the lease webinar 3.
Thanks, guys. We do have another one, assuming you guys still have time. So the other question was, are software arrangements covered under the lease accounting standards?
So that's a tricky question. I'll call it the easy answer would be no. Software typically is an intangible asset, and those are not covered under topic 842. However, you do need to review the lease agreement. If there is any hardware components in there, that might be an identifiable asset. If you are using a server that the lessor has on property, but that server has only your information on that, and you control, or the lease defines that the lessee controls what's on that server, that potentially could be an identifiable asset and covered under topic 842. So the easy answer would be typically no, but make sure your lease doesn't have any identifiable hardware components or assets within it. Any other questions?
We have another one, yes. Would a landlord with multiple rentals need to account for each lease if the leases were less than 12 months long? If the leases are longer than 12 months, then topic 842 applies, correct?
Correct.
That's correct.
Okay, and we do have another question, but I will just say that there's still time. So if you guys want to keep throwing some more in the Q&A box, feel free. The other one we have is, does topic 842 apply to intercompany lease arrangements?
So topic 842 would not be applicable to intercompany leasing arrangements because those agreements would be eliminated in consolidation of the financial statements. So in that case, you would not need to apply topic 842 to those agreements. However, there could be some related party disclosures that would need to be disclosed in the footnotes. And I know during part 3 of our webinar, we will touch more on related party leasing arrangements.
Awesome. Those are all the questions that we have as of right now. I'm not sure if you, Kevin or Kristi, have anything else you'd like to add, but we're out of questions.
No, I don't have anything else to add. Again, if anybody thinks of questions after the fact, after the webinar is over, feel free to email directly myself or Kevin. And as Caitlin mentioned, if the survey doesn't pop up for you, it should be emailed to you within 24 hours.
And I would just like to, conclude with thanking everybody for joining us today and educating yourself and taking a step in the right direction, on the new lease standard.
Yes, thank you everybody for your attendance, and hopefully you'll all join me in the second lease webinar, which is next Wednesday. Thank you.